Greetings, Peter Nelson, founder and chief executive officer of Full Service Property Management. I want to talk to you today a little bit about a great vehicle for transferring real estate or getting out of one real estate and into another. I need to preface this with a disclaimer by saying that I'm not a lawyer, I'm not a tax accountant. Before you try any of the ideas suggested in this video, please consult one or more of those professionals. But there's a couple of vehicles that the government has in place to help investors of real estate. The one thing about real estate that if you haven't looked at some of my other videos, you'll soon learn is, one, I'm really bullish on real estate and rental property. Number two is real estate creates an incredible amount of equity. So a property that you might buy for, say, $200,000 in another 5 or 10 years from now, that thing could be worth $400,000 or $500,000. And so when you go to sell it, you could potentially be on the hook for paying taxes on, in that instance, $200,000 or $300,000. The government's given us real estate property owners a couple of outs, a couple of ways to avoid or at least delay paying the taxes on that sale. The first is kind of the Homeownership Rule, which is that if you've lived in the property any 2 of the last 5 years from the date you sell it, then it's considered a personal home, subject to certain thresholds on basically not paying any capital gain taxes. And again, you need to consult what those laws are, because tax laws are constantly changing. The other one, though, the one I want to focus with in this video about, has to do with 1031 exchanges. And 1031 refers to the section of the IRS code in which this is all written down. And in a nutshell, it basically says that you can take that $500,000 property that I was referring to earlier, the one that you bought for $200,000, it's now worth $500,000. And you can sell that property, and you can avoid or delay, I should say, having to pay taxes on it, capital gains taxes, by rolling those capital gains into what's called a like-kind property. Usually it's real estate. These are pretty complicated transactions. There's quite a few restrictions. So you want to go into it with your eyes open and not really based on this particular short video. But one of the things is currently is it the property you are acquiring needs to be equal to or more than what you are selling. So if you sold a $500,000 piece of real estate, you need to buy something $500,000 or more. The other requirement is that you don't get to put your hands on the money. They're not going to let you do that. Basically, you have to employ an exchange facilitator, and he works with the escrows that will then will receive money from the escrow of the property you sold and will transfer money to the escrow of the property you are buying. There's one other nice little option that the government gives you, and that is that you do not have to sell the property first. And so it means that, I forgot to give you this, is that you have 6 months to complete that exchange. Now, you can sell the property, and when you sell the property, the clock starts running, and you got 6 months to buy another property. And if you don't buy that property within 6 months, you're out of luck and you're probably paying capital gains taxes. Or you can find a property that you want to buy it, and then sell the other property within 6 months and avoid capital gains on that other property. Arranging the financing on the property that you're purchasing might take some creativity in that situation. But those are just some of the items or issues surrounding 1031, 1031 tax-free exchanges. These are great vehicles. I've done one or two myself for delaying taxes. I want to give you one final note, though, is say you buy property A for $200,000, sell it for $500,000, or 1031 exchange it, into another property. So yeah, you do sell it for $500,000. Work with me on this. Buy another property through a 1031 exchange for $600,000. Own that for a few years. Sell it for $1 million. I mean, this is the kind of power that real estate has. This is not far off. If you do go and sell at that point, your basis is typically going to be at that lower amount. So you want to make sure that when you sell that $1 million, you're at a lower tax rate. Unemployed, retired, something like taking time off. But you just have to be aware. And this is just a quick primer. I don't want to go into all the details because they are fairly complicated. But it's called 1031 tax-free exchanges. Look them up. Do some research on them. They're great vehicles for delaying the payment of capital gains taxes on rental real estate. And it's a great way for building wealth through rental real estate. Make it a great day.